Hey everyone, and welcome back to The Explainer. Today, we're putting on our expert analyst hats to run a full corporate diagnostic on Quaker Houghton, ticker symbol KWR. We're going to be hunting for economic moats, dividend stability, and balance sheet strength to see if this invisible industrial giant holds true intrinsic value. Let's get right into it.
So, to kick things off, think about this. What actually keeps the global steel and auto industries running smoothly behind the scenes? When we look at these massive manufacturing plants, aerospace facilities, or huge mining ops, it's so easy to just focus on the heavy machinery, right? But honestly, there's an invisible giant powering all of this manufacturing. They make sure those machines don't overheat, break down, or rust out. Without these specific fluids, multi-million-dollar factory lines would literally grind to a halt in hours. And that invisible giant? It's Quaker Houghton.
Okay, here's our roadmap for today. We'll start with the invisible industrial giant. Peek inside the financial ledger, look at their decades of dividend consistency, analyze their competitive moat and risks, and finally look ahead to 2031.
Starting with Section 1, the invisible industrial giant, powering global manufacturing.
To really ground this, let's break down what Quaker Houghton actually makes. They are the global leader in industrial process fluids. But okay, what does that mean on an actual factory floor? Basically, think of it like the motor oil in your car, but engineered on a massive, incredibly complex scale for industrial machinery. We're talking about highly specialized chemical products, stuff like fire-resistant hydraulic fluids, metal removal fluids, casting lubricants, and surface treatments. These aren't just your run-of-the-mill liquids. They are highly engineered solutions designed to reduce downtime, drastically extend tool life, and really drive competitiveness for manufacturers in a fast-paced world.
And this next number just brilliantly captures their massive scale, 15,000. They serve over 15,000 customers. From an investment standpoint, this level of diversification across more than 25 countries means they absolutely aren't relying on just one or two big clients. You might remember, Peter Lynch always loved these kinds of robust, heavily diversified stalwarts. Their client list is practically a who's who of the world's most advanced steel, aluminum, auto, and aerospace companies.
Zooming out to the broader industry, the metalworking and process fluids market is huge, estimated to be worth somewhere between $16 and $18 billion. And Quaker Houghton, they hold an estimated 10 to 12% share of that entire global market. That solidly positions them as a top 3 player worldwide, giving them incredible leverage and deep integration right into the global supply chain.
Moving right along to Section 2, inside the financial ledger, looking at top-line and bottom-line growth. So for the full year of 2025, Quaker Houghton delivered a really solid net sales figure of $1.89 billion. And what's impressive is they achieved an adjusted EBITDA of $299 million, despite a persistently soft macroeconomic environment. That is a massive indicator of management's pricing power and operational efficiency. They're basically offsetting macro pressures by winning new business and optimizing their manufacturing networks. When you look at their recent momentum, you can clearly see the jump from Q1 2025 to Q1 2026. Net sales grew to over $480 million. But the real standout here? Look at that net income. It leaped from $12.9 million all the way up to $19.7 million. That was driven in a big way by year-over-year organic volume growth, especially in the Asia-Pacific region, which, by the way, just celebrated its 10th consecutive quarter of growth.
Now, what's really interesting about this is how effectively that top-line volume growth translated straight to the bottom line for investors. Basic earnings per share shot up from 73 cents to $1.13. When you're trying to figure out a company's intrinsic value, this kind of super efficient conversion from volume to bottom-line profit is exactly what you want to see. It proves their cost controls are functioning flawlessly.
All right, on to Section 3, decades of dividend consistency and how they're rewarding shareholders.
This number, 16, is a huge green flag. If you follow Benjamin Graham's defensive investing checklist, Quaker Houghton checks a massive box right here. They have successfully increased their dividend for 16 consecutive years, and they've done it through some incredibly cyclical, choppy economic environments. That is a serious track record of returning capital to shareholders no matter what the global economy is doing. You can literally see this consistency with the steady upward staircase of total annual dividends over their last 3 fully reported years. They went from a total of $1.76 in 2023 up to $1.85 in 2024 and reached $1.96 in 2025. and they're actively keeping this up. For the first quarter of 2026, they declared a dividend of just over 50 cents per share. On top of that, the board authorized a $250 million stock repurchase program. That's a classic signal from management showing they believe their stock is trading below its intrinsic value. Plus, if you're a long-term holder, they offer a dividend reinvestment plan, or DRIP, which lets you compound your position without getting eaten up by transaction fees.
Let's pivot to Section 4, Competitive Moat and Risks, analyzing their structural advantage. The crucial point here is understanding the balance. Quaker Houghton's strengths are undeniable. Massive scale, deep, entrenched relationships with global OEMs, and super sticky service contracts. But they aren't totally immune to industry vulnerabilities. They do face risks from a highly fragmented landscape of smaller job shops over in the Asia-Pacific region, aggressive pricing tactics from big oil majors, and the always looming threat of volatile raw material cost swings that can really compress their margins.
To defend against those raw material swings, though, they've built a seriously wide economic moat. They don't just sell drums of chemicals and say, "See you later." They monetize through technical service contracts and on-site fluid management fees. They actually embed their own chemists and engineers directly onto the customer's factory floor to manage those fluids day in and day out.
There's a quote from an industry analysis that perfectly captures why this is such a big deal. It says, "Recurring revenue comes from multi-plant agreements and lubricant recycling programs that raise customer lifetime value." By embedding themselves so deeply into the daily operations and even the sustainability goals of their clients, they create a deep, recurring competitive moat that drastically cuts down on customer churn. Once Quaker Houghton gets in there, it is incredibly difficult and expensive for a manufacturer to switch to someone else.
Finally, Section 5, looking ahead to 2031, diving into strategic financing and sustainability.
Let's see how they're building a runway for the future. In April 2026, they went ahead and restructured their corporate debt, pushing their nearest maturities way out to 2031. If you're running a discounted cash flow valuation model, this is huge. This unencumbered 5-year window drastically lowers their near-term risk profile. It gives them the breathing room to focus purely on executing strategic M&A and driving organic growth, completely free from the stress of refinancing pressures.
The actual mechanics of that April 2026 agreement are pretty impressive. They secured a $550 million US term loan, a €250 million term loan, and set up a massive $800 million revolving credit facility. This swift, strategic move significantly improved their credit terms and vastly increased their available liquidity. So, where are they pointing all that capital and growth? Straight towards sustainability and high-margin innovation. They're shifting heavily toward water-based, low-VOC chemistries and making a big play in the EV and battery markets. And honestly, it's paying off. They recently ranked in the top 13th percentile of all companies assessed by EcoVadis, earning a silver medal. But remember, this isn't just about being good for the planet. This is a highly targeted, high-margin business strategy.
To sum up management's outlook, CEO Joseph Berquist said, "With increased financial flexibility, we are well positioned to execute our strategy, achieve our capital allocation priorities, and continue investing in both organic growth and strategic M&A. It's a really confident stance, fully backed by a freshly optimized balance sheet." So we've covered their massive scale, the solid financial growth, those incredibly steady dividends, and a famously wide economic moat. I'm going to leave you with this final thought to chew on and analyze for yourself. Does Quaker Houghton's sticky, recurring service model truly outweigh the inherent, messy volatility of industrial commodity costs? Thank you so much for joining me on this explainer today. Keep running those numbers, and I'll catch you next time.